In 2021, I did a really good month. I think in that month I made $20 million in 1 month.
When you had that huge month, what were you feeling at that time?
I was feeling.
If you've never heard of him before, let me introduce you to Steven Dux. One of the most successful retail stock traders of his generation, Steven Dux is widely known for turning a $27,000 trading account into over $10 million through disciplined small-cap day trading. Years later, he would go on to surpass $50 million in total trading profits, earning a reputation as one of the most respected traders in the industry. But his journey wasn't built on luck. Behind the millions lies a story of relentless discipline, countless failures, and an obsession with mastering the markets. So in this video, we will be covering his trading strategies and how we can implement them to our trading journals. All right, let me set the scene for you. It's 9:31 in the morning. The market just opened 1 minute ago. And out of nowhere, some small, barely known company drops a press release. Maybe it's an earnings beat nobody saw coming. Within seconds, the stock is up 20%. A few minutes later, it's up 80%. By lunchtime, some trader somewhere is staring at a chart that's up 300% since the sun came up, and their hands are literally shaking. Not because they're scared, because they think they just found the trade of a lifetime. And look, I get it. If you were watching that chart, you'd probably feel the exact same pull. It's the oldest impulse in trading. Something is ripping higher right in front of you, and the fear of missing out gets so loud it drowns out everything else. So people buy. And then they buy more. Now here's the thing. Steven Dux was looking at that exact same chart, and he wasn't buying a single share. He was just waiting. So let's actually break down how this works, according to him. It starts with something most traders never really stop to think about. A stock doesn't just go up because a company suddenly became more valuable overnight. It goes up because thousands of individual people who've never met each other, who don't know each other exist, are all making the exact same emotional decision at the exact same time. And emotional decisions, no matter how strong they feel in the moment, don't last forever. There's a ceiling on how far pure excitement can carry a price, even if nobody knows exactly where that ceiling is until the crowd runs straight into it. The way Dux describes it, almost every one of these explosive moves goes through the same basic stages. First, you get the spark. Then comes the stampede. And then, at some point that's impossible to predict in advance, but really easy to spot afterward, the buying just runs out. Not because the news got any less exciting, but because everyone who was ever going to get emotional about that headline already has. Once that happens, the same crowd that pushed the price to the moon suddenly starts scrambling for the exit, except now that exit is a lot more crowded than the entrance was. To Dux, that turning point right there is the entire trade. He's not trying to short the exact top, and he's not trying to nail the exact bottom either, because let's be honest, nobody can consistently do that. What he's actually watching for is exhaustion. To him, that's the tell. That's the sign the crowd's conviction is starting to crack, even before the price itself has turned. But just spotting that emotional crack is not enough on its own. Dux has been really open about this. Before he'll actually put on the trade, the stock has to pass through a whole second checklist. The first one is market cap. Now, in case you're not familiar, market cap is really simple. It's just the total value of a company on paper, basically the share price multiplied by the total number of shares that exist. And Dux tends to hunt specifically in companies with a market cap under roughly $1 billion. And honestly, a lot of the time, way smaller than that. Why? Because that's the range where a wave of excited retail buyers can actually move the price with their own money. Once a company gets too big, there just isn't enough retail excitement in the world to keep pushing the stock higher, and the whole pattern falls apart. The second condition is float. And again, in case that term is new to you, float is just the number of shares that are actually available to be bought and sold on the open market right now. It's not every share the company has ever issued. It's the ones sitting in the hands of everyday investors, ready to trade. A stock with a small float can swing wildly on relatively small amounts of buying or selling, simply because there aren't a lot of shares to go around. Dux has said flat out that he narrows his search down to these low-float names specifically because of that effect. On top of market cap and float, he's also watching volume, meaning how many shares are actually changing hands, especially in the pre-market hours before the opening bell. Because here's the trap. A stock can look absolutely explosive on a chart while barely anyone is actually trading it, and that kind of move is way less reliable. And then there's price itself. He tends to stay away from ultra-cheap, penny-level stocks because those come with their own chaotic behavior that doesn't follow the same rules. And even once every single one of those boxes is checked, he's still careful about size, meaning how big of a position he actually takes. So really, when you zoom out, it's two completely separate checks working together at the same time. And according to him, if you skip either one of those halves, you're not actually running a system anymore. You're just gambling with extra steps. Now, you've probably seen the bigger, more famous versions of this pattern, even if you've never placed a single trade in your life. Think about GameStop, back when it turned into a household name pretty much overnight. Or AMC, when a struggling movie theater chain suddenly became this massive trading phenomenon. Those were just the loud, headline-grabbing versions of a pattern that plays out quietly in much smaller and less famous stocks almost every single week. What actually makes Dux's approach different isn't some secret ability to predict the news. He's not trying to guess whether the earnings will beat expectations or whether the drug trial results will hold up. He genuinely doesn't need to know any of that. What he's studying instead is what that news does to people the moment it hits their screens, how it makes them feel, how that feeling shows up in the shape of a chart, and how reliably that feeling eventually burns out and flips into its exact opposite. And that's really the whole difference. The chart that looks like the best opportunity of the day to almost everyone watching is, to him, basically a countdown clock. Not a question of if the excitement fades, just a question of when. And his entire edge comes down to being patient enough to sit on his hands and wait for that moment, disciplined enough not to get swept up in the euphoria himself, and precise enough to only actually pull the trigger once every single condition, the emotional side and the mechanical side, lines up at the same time. Because at the end of the day, stocks don't just move because of numbers on a spreadsheet. They move because of human nature. And human nature, no matter what year it is or what stock it's happening to, has a habit of repeating itself over and over again. Which means if you know how to read it, so does the opportunity.